Welcome to Flip Chicks, everyone. Appreciate you guys being here tonight. Tonight, we're going to be talking about how to fund your deals in the age of the COVID-19 virus, the pandemic, the quarantine, what we're all experiencing for the first times in our lifetime, and hopefully the last time. I was watching Fox News last night, and some of the political leaders like Cuomo up in New York was saying that things may never, ever go back to normal. And I think Gavin Newsom was kind of saying the same thing. I don't know about all that because many of us want things to go back to normal. Hopefully they will, but we may be in this for a little while. We don't know how long we're going to be in it. We're going to be in it for at least another 30 days, according to Trump. But according to some of the virus projections, this thing may not hit its peak till sometime in May. And if you guys know anything about a virus, it goes up real strong, peaks, and then comes down pretty sharp. Well, by doing all this quarantine and wearing masks and washing your hands, they're trying to flatten that curve out. Where instead of having 2 million potential deaths here in the US, they're trying to get it down and keep it under 200,000 deaths, which is an enormous amount of deaths. So it's pretty scary. And I'm glad that you are here with us tonight and that we're able to go through this together and, keep each other company as best we can, keep each other motivated, share our experiences together, help one another out through this situation as best we can. So I really appreciate you guys being part of our REIA groups and being friends and being part of the family. So thank you for being here tonight. So we're going to be talking about how to attempt to not only survive what's going on right now, but also try to thrive. Many of us are in this business full-time. As full-time real estate investors, we don't necessarily have day jobs. Some of you that have day jobs may not be in your day job right now, unless it's one of those essential businesses, whether you're a healthcare worker or something like that. You may be out of work. Well, how do you survive? How do you eat? How do you pay your bills if you don't have a lot of money saved up? Well, many of us are out there trying to still do deals, even though we're, under the stay-at-home order. So tonight we're going to be talking about how to get your deals funded during this pandemic, if it's even possible, and we're going to talk about what's changed. So we're going to talk about what's going on right now, and then hopefully get some opinions from our panel of what it's going to be like when we come out of this. If they can even guess, or if they've heard, or if they know anything and can predict the future a little bit. So I'm glad to have these guys with us here tonight. We've got Karen Hall from Ameris Bank, Stephanie Langford from DFW Hardmoney, Kenneth Igwe from Baker Columns, and Nate Wolosiewicz. I hope I didn't mispronounce your name. I'm sure I did. You can correct me later when you come back on. But he is from Civic Financial. You guys may know Joseph Castaneda. He's with Civic as well. And you probably met some of their folks around. So I appreciate you guys all being here tonight. Flip Chicks is normally hosted by Christine Griffin, my wife, and Maria Rosenzweig. I don't know if Maria's online or not tonight because Maria and Chrissy have no idea how to run a webinar. So I'm running it tonight. They're probably watching in just like the rest of you are. So again, I appreciate you guys all for being here tonight. Before we get started, I want to make a few brief announcements since there's a lot going on. Again, welcome everybody, whether you're a member or whether you're one of our guests. We appreciate you being here and spending some time with us tonight. I did invite people from our Tampa REIA group, Atlanta REIA, Savannah REIA, and Chattanooga REIA, and anybody else out there who's a non-member to join in tonight. Just check us out, see what we're all about, and hopefully give you guys some insights on what the lending market is doing right now. So I want to tell you about a couple upcoming events we have because we've had to move everything online and we've done it as quick as we could. Shark, and by the way, no matter which REIA group you're a member of, whether it's Charlotte, Savannah, I said Charlotte, I meant Chattanooga. I used to be involved with the Chattanooga REIA or Tampa REIA. Just go to your calendar on our website to see what's coming up and what's changed. Because I'm posting a lot of our Atlanta events on Chattanooga, Savannah, and Tampa because they're all online. There's no reason you can't check them out too, because proximity is no longer an issue. So check our calendar for the latest updates. So tomorrow, or not tomorrow, Monday is Shark Tank. We usually do this in person. People usually bring in their deals and we analyze them on the spot. Since we can't really do that as well online, what we're going to do Monday is on the webinar, I'm going to have Don DeRosa, Roger Blankenship, and Scott Sekulow, 3 sharks, local sharks who are still doing deals, who still want to do deals, who are still looking for deals. I want to talk to them about what's changed. We know there's a pandemic, but what have you changed in your business to still be able to buy houses? Are you offering the same amount? How are you calculating the ARV now when you don't really know what the ARV is going to be in a few months? Are you still offering 65 to 70 cents on the dollar minus repairs? Have your formulas changed? Is the way that you make offers, has that changed? And if so, how? I know Scott Sekulow, for example, does a lot of cash offers. Well, have his cash offers come down for the exact same house we saw a month ago? For the exact same house, is he offering less today? If so, why and how much? These are some of the kind of questions we're going to be covering on Monday. And are any of these gentlemen doing something other than all cash offers? Are they asking for any kind of seller financing? Are they doing subject to, wraparound mortgages, sandwich leases? What's going on? So we want to talk to these 3 and find out how this has affected their business and what they're doing about it to adapt and overcome and attempt to survive and thrive in this new environment. The on-site renovation group is usually on the 1st and 3rd Tuesday of the month. They're canceled until further notice, since we do them live and in person with all you guys. If we do bring it back anytime soon, since we're at the stay-at-home order right now, we're not doing it. But if they loosen up on that, we may start going out and meeting again, just a few of us, and recording it and broadcasting it online. We'll see. No promises there. The Property Protégé group meets this Wednesday and every Wednesday. Chrissy and Don are running this group. If you're looking for some group coaching and need a local coach, check it out. They're letting people attend their first meeting for free. If you go to area.us/ppg online, you can sign up right now. No matter where you are in the country, you'll be able to watch in. And by the way, I didn't mention this on Shark Tank, but it's free for our Atlanta REIA members, Tampa REIA members, Chattanooga REIA members, Savannah REIA members. If you're a non-member of any of those groups, it's only $10 to join in. We're doing a lot of things online free right now, but some of our groups we still do charge for because we got to survive and eat too. So Roger Blankenship runs the Creative Deal Structuring Lunch every Wednesday at noon. He's put it online. It's at area.us/CDML. That is a Zoom meeting. Tonight we're on a Zoom webinar. That is a Zoom meeting where everybody's videos pop up on the screen and you guys can all kind of talk at once, or not necessarily at once, but talk together. Unlike a webinar, which we're on tonight, where it's kind of one way. We're talking to you and you guys are kind of listening and asking us questions via the Zoom Q&A interface. Joe canceled his last 2 meetings, but as of yesterday and next week, he has put them online. He's attempting to do haves and wants online. I wasn't on it yesterday to see how it went, but you can sign up at area.us/haves and wants. Take a picture of these screens. He gave me a meeting ID and a password. I don't know if that's necessary or not, but he gave it to me. So there it is in case you needed to sign on. And then Roger also runs the Flipping Atlanta group every Thursday. He's moved that online as well. And the sign up link is area.us/FA for Flipping Atlanta. So these are groups that, in fact, the past few ones I've mentioned, these are all free except for the Shark Tank, which is only $10 for non-members. Now, because we're going online and doing this all online, next week we have our Tampa REIA group and you're invited to attend. I'm going to be running from right here where I am right now for our people down in Tampa, and you're welcome to attend if you're a Atlanta REIA member. In fact, you don't even have to be a member. I'm opening up the doors for everybody to come to Tampa REIA next Thursday. So anybody in the country that's listening tonight can join in. You sign up at trea.us/online. Now, the gentleman on the screen there is going to be our speaker, and guess where he's been for the past 2-3 weeks? In the hospital with, guess what? COVID-19. He suffered from himself. He just got discharged, I think, the day before yesterday. He's at home under quarantine, and he was dealing with really bad case of pneumonia. So they were treating him for that, and they said, hey, let's give you a COVID test to make sure you don't have it. Sure enough, he did. So he's at home alone, trying to recuperate right now. I asked him like 5 times, are you sure you want to do this next week? Are you sure you want to do this next week? He said, yeah, it gives me something to look forward to. And I'm getting bored sitting here, laid up in bed for weeks. So he's going to be broadcasting from his house. He's going to be talking about the state of the market. Tonight, we're talking about the state of the market as far as lenders are concerned. Monday at Shark Tank, we're going to be talking about how we change our offers during this pandemic and maybe beyond. And Lee, who's a multimillionaire real estate investor, is going to be talking about the current state of the real estate market as he sees it, his predictions for the future, and how COVID has affected him personally, his personal life, his business life, and his health. And he's going to share some of that with you. Don DeRosa is going to be our speaker at 6 o'clock, the meeting before the meeting, talking about making creative offers during the pandemic and after, based on people not being able to afford their payments anymore. So check that out. And then about a month ago, we had the 2-day foreclosure summit with the Twyfords, who are on the screen right now. Our first one was up in Chattanooga right when it was about a month ago from yesterday. The actual workshop is a month from this weekend. And the pandemic was just starting. People were just starting to get nervous. We had kind of a smaller turnout because of it. And we're doing this online version, because that one was in person, to give people a chance to come see this who didn't want to because of the pandemic. So a week later, we did it in Tampa, had a full house. I think we sold probably 50 seats, and we had at least 30 to 35 or so show up. So it was full, but several people didn't show up because the pandemic had started. It hadn't hit Florida real hard yet. People weren't totally freaking out yet, but attendance was down. So we're doing this event so that those folks can come back and attend this one online from the comfort of their home. Same thing happened the following week in Atlanta. We had over 77 people signed up for the event, and about 28, 29 showed up, which is about a third. And by then, Atlanta was a ghost town. In fact, it was our last live event. We were real reluctant to do it, but we did. Everything turned out okay. Had a real good 2-day event. But again, about 2/3 didn't come because of the pandemic. Well, here's your chance. If you signed up and attended either one of those 3 events, or you missed it and you signed up, go to that link, area.us/summit, and use the coupon code REPEAT. So if you've already paid for it and made it or didn't make it, either way, you can come back and repeat it. It's a 1-day event instead of 2, and he's going to be totally focused on, what to do during this pandemic and beyond, how to keep on making money as best we can, how to keep on generating leads. If you are a member, I believe it's $20 if you're attending it for the first time. And if you are a non-member, I believe it's $50. And before I wrap up my comments tonight, I will tell you a way to come to this event for free, as well as the one that's on your screen now. Atlanta REIA is going to be on the 13th of this month. I'm opening the doors to everybody to attend for free. It's going to be online. So people from Tampa can join us, Chattanooga, Savannah. You guys can all join in. Sign up at area.us/online. We did the Chattanooga REIA meeting last night with this gentleman. Did a real good job. The title of his presentation doesn't really do his presentation justice, but he spent a lot of time talking about how to buy houses creatively, which is very relevant to what's going on right now. He spent a lot of time talking about creating seller finance notes. And then at the end, he started getting into what to do with those notes, how you can actually flip notes, create notes, sell notes. but he spent the bulk of the time talking about creative deal structuring. And some of the information was new to me. I'd never heard it, and I heard it for the first time last night. So if you get a chance, sign up for Atlanta REIA. It's going to be on the 13th. And then he's coming back for a full day workshop. If you like what you hear at Atlanta REIA in an hour and a half, if you like it, you can sign up for this full day workshop where he'll go into much greater detail. It's going to be on the 18th. You can sign up at area.us. No, that's a typo. It should be area.us/NS. So that .co is a typo. It's area.us/NS. And it's $20 for members, and it is $40 for non-members. So if you join one of our REIA groups tonight, whether it be Chattanooga, Savannah REIA, Atlanta REIA, Tampa REIA, because you're a non-member, you can come to both of these workshops, both of these online workshops at no charge as a thank you for becoming our member. And I'll show you how to sign up for Atlanta REIA here in just a minute. If you want to sign up for one of the other REIAs, just go to the website, tamparea.com, chattanoogarea.com, or savannahrea.com, and click the membership link. So we've got a lot of other meetings coming up this month that I don't have information on yet because we're still setting them up to make them go online. But we've got the beginning investor group coming up on the 3rd Monday. We've got Flipping Gwinnett coming up on the 3rd Tuesday. We've got the short-term rental owners networking group, which is on short-term rentals. They're getting hit hard right now. That's going to be on the 2nd Tuesday. We've got the West group coming up on the 4th Monday. We've got Marketing Madness coming up on the 4th Thursday. And then we got Hardcore Wholesaling coming up on the 4th Tuesday. So I don't have any information on available for you right now to sign up, but we will before the week's over next week, where you can sign up for those. So to keep an eye on this, because there's so much going on and so much changing, just go to atlantarea.com and check our calendar anytime you want to know what's going on. So I mentioned if you join our REIA group for $100 for the year, you can attend the Investor Summit online for free, and you can attend the Note School full day workshop at no charge as a thank you for joining for $100 a year. If you have your spouse join for an additional $50 for the year, or a parent or a child, they can attend for free as well. So for $150, both of you can join for the entire year and come to all of our meetings for free except for 1 or 2. We do have a few meetings such as Hardcore Wholesaling where there's a small door fee even for members, but everything else is free except for the workshops. So I'm almost done panel, just so you know. I'm going to be wrapping it up here momentarily. I want to tell you quickly about our Atlanta REIA VIP list. This is so you can get periodic text alerts from me about all these events that we have going on and things that are changing. Just text the word START to 678-944-9840. That's 678-944-9840. And since I have that screen up, if you'd like to join our buyers list, where we can send you periodic updates on off-market properties, or if you want to hit our VIP list, it's about $35 and it goes out to about 1,200 people. If you've got a hot property for sale and you want to hit that list, just give us a call and let us know. But if you want to join the VIP buyers list, text the word buyer to that same number that's on the screen right now, 678-944-9840. All right, do you guys have any questions before we start the panel? Let me check the Q&A interface real quick. Mark was earlier we were talking about, I was telling you guys where to find the Q&A interface. Sometimes your toolbar will minimize itself and you have to mouse over it to get it to pop back up. And then you can click the Q&A box. Like right now, mine's minimized. I can't even see it. So if I move my mouse up to the top of the screen, it reappears, and there's the Q&A interface. So if you guys have any questions for me, send them in right now. Otherwise, I'm going to bring our panel on. Panel, are you guys ready? And by the way, I did have a couple questions come in real quick while you guys are kind of logging on. Anthony said, can you show us the buyers list again? Anthony, if you're in the Atlanta area, the number on the screen is the buyers list number. Just text the word buyer to that number. 678-944-9840. I hope that helps. And by the way, we've got a buyers list and a REIA list, just like this, for Savannah, Chattanooga, and Tampa. You just have to go to those respective websites if you're from one of those areas and join it there on the top of the homepage. Okay. It's free. Zipporah asked how much is to join the VIP list. It's free. You just text in that the word buyer and you're on it. You should get an autoresponder real quick back. If you want to hit it, it's about $35 and it goes out to about 1,200 people. And I can give you more detail on that. If you're interested, just contact me through the website, atlantareia.com. Go to the contact us box and get a hold of Chrissy through the number or email us and we'll get you set up. Champ asked, are all the properties off market? Yes, because people like you say, Dustin, I want to hit your list because they can't hit it without me. And it's just for off market properties. So the answer is yes, it's for off market properties. If you're in Tampa, which link to use? Raj, link to use for what? You didn't really say, but if you go to tampareia.com, you'll see the menu bar. You'll see the number to text and all that, if that's what you're asking. Okay. Okay, Lynette, you sent in a question for our lender panel, so we're going to hold that one for just a little bit, but thank you. So from now on, I think I've answered all your questions. If you guys have any questions for our lenders from this point forward, send them in via the Q&A interface. When these guys introduce themselves, I'll let them tell you where they lend. And just so the panel knows, right now we're broadcasting to our Chattanooga group in Tennessee, our Savannah REIA group here in Georgia, Atlanta in Georgia, and our Tampa group down in Florida. And then anybody else who happens to be listening in, because I shared this link on a lot of our Facebook groups across the country, at least across the kind of the southeast. So once again, everybody, welcome to the call. If you're just now joining us, we've got Karen Hall with Ameris Bank. We've got Stephanie Langford with DFW Hardmoney. We've got Kenneth Igwe with Baker Collins and Nate Wolosiewicz with Civic Financial Services. Now, Nate, please correct me if I mispronounced your name.
You actually have done much better than most people. So it's Wolosiewicz, but that is butchered. I'm used to much worse, so well done.
Yeah, because I noticed your email was Nate Wolo.
Yeah, nobody wants to spell that. Not even me.
It's definitely a lot easier to say. Say it one more time for me.
Wolosiewicz.
Wolosiewicz. Okay,
yes.
That's going to take me a minute to get right. Wolosiewicz. Wolosiewicz.
Been 44 years, so there's a little forgiveness there.
So, I'm glad to have you all here with us tonight. When this pandemic first hit, we had several of our students trying to get funded through, not necessarily through anybody on the call tonight, but through other lenders throughout town. And they were in the process of getting approved, or had been approved, getting to closing, then got shut down, which is not terribly unexpected. I've heard Gervy telling us some, deals blowing up at closing because the funding, the lenders pulled back out. I posted something out on Facebook about who's still lending, and many of you answered it. And some people said they were, some people said they weren't. Some people said they are, but things have changed dramatically. So that's kind of what I want to get into tonight. But before we do, I wanted to kind of go in the order of your pictures up on the screen, which I'm getting ready to turn off. That way we can blow your pictures up real big. But I'm going to have Karen go first, then Steph, then Ken, then Nate. I want you guys to kind of introduce yourself personally, how long you've been in the business, what your involvement is in the real estate industry, and specifically talk about your company and the types of things you do for real estate investors, the type of loans you do and things like that. So just kind of introduce yourself and your company.
Hey everybody, I'm Karen Hall with Ameris Bank. So I've been in the mortgage industry for 20 years and I don't know what else I would do. I'm very passionate about what I do. I care about my customers. I believe in giving them knowledge and education so you can make a financial savvy decision for yourself and your family. So I moved to Atlanta 2 years ago. So hello to the Savannah market. I'm from Hilton Head, South Carolina. I lived there for 14 years and where I joined Ameris Bank, and then I transferred to Atlanta 2 years ago. I just celebrated my 5-year anniversary with Ameris, and I'm in love with my bank. There's nowhere else I would rather go or rather be. And especially in this environment, I'm glad I'm with a bank, and because it's tough out there. So if you don't have the stability and the strength with the money and the liquidity and the support, you're not going to survive in this market. So I've already been through 08, 09 in Hilton Head, and it was tough. It was a hard climb out, but we made it, and here we are again. I think the mortgage industry is smarter. I think we're more prepared, especially with Ameris Bank. We are here to help. I'm not here to deliver bad news. We have curtailed a little bit of our portfolio guidelines, and we're going to talk a little bit more about that. But we have come up with solutions to assist so our customers can still purchase and refinance.
Yep. And I don't want you guys to sugarcoat things tonight. I mean, if you've got bad news, deliver it. We want to hear it, hear it straight. So don't worry about that.
Well, I'll start off with the not so good news. But so anytime that we have a crisis like we're going through right now, so we have to always protect the bank. And so some of our portfolio products are non-QM products, so like the fix and flip and the fix and hold, and our lot loan program has been temporarily suspended, but we still have the Fannie Mae home style renovation loan. So and I always tell people the difference between me being the bank and the hard money lenders and the private lenders is that I have to income qualify each borrower with a tax return with a qualifying positive cash flow on that, or a pay stub and a W-2.
And I am going to want you guys, I am going to come back. One of my follow-up questions is going to be a little bit what you just got into about what's changed, what can you still do, what can't you do. So you gave them a little teaser there, but we'll come back to you on that. But
okay.
Just so you guys know, Karen's a traditional lender with Ameris Bank. Stephanie, who's getting ready to introduce herself, is a private, what I would call a private lender. They're a hard money lender, but when I say private lender, meaning it's their money. They're not borrowing it from somebody else and relending it out necessarily. They're not getting it from a warehouse line of credit and then lending it out. It's their money in-house. And Stephanie will mention that. And then Nate and Kenny are a lot of your traditional hard money lenders. So that's kind of the difference between some of the folks on the panel tonight at a glance. But I'm gonna let each one of them kind of introduce themselves and tell you how they're different from some of the other folks on the panel tonight. Stephanie, you wanna go next?
Yeah, my name's Stephanie Langford. Like Dustin said, I'm currently with DFW Hard Money, but I've been in the real estate industry for about 6 years now. I'm one of the younger people out here. I started out as a receptionist actually for a broker, and kind of became an agent and did that full time, and then got into hard money just actually less than a year ago. But I love it. It's hands down my favorite job that I've ever had. Right now, speaking of good news, bad news, just with the state of the market and the uncertainty that we have going on, we have actually paused lending for 30 days. As of about a week and a half ago, we made that call. We're still doing transactional funding, and anything that we had in the pipeline, we didn't drop. But we are not originating anything new for the next 30 days minimum.
So tell us a little bit about your company real quick. Who's the founder? How long has it been around? What you guys specialize in under normal circumstances?
Yeah, so we're really for quick closing. So my founder, the owner of my company, John Pribble, who you've actually known for quite a
Long time.
20 years, something like that.
Yeah.
John founded DFW Hardmoney about three or 4 years ago, and he, just wanted to innovate the process. He had over 1,000 real estate transactions under his belt. He knew what investors needed in order to, for a hard money lender to be different in the marketplace. So the biggest thing with us is we approve all of our deals up front, and we can close and fund same day. Because like Dustin mentioned before, we are using private money. So that's how we're able to move so quickly.
Yep. All right. Thank you, Steph.
Yep.
How about you, Kenny?
Hey guys, can everybody hear me?
Yes.
Oh, awesome. So
Good.
my name is Kenneth Igwe. I'm with Baker Collins and Company. We're a private money lending group here in Atlanta. We will turn 5 years old next month, which I'm really happy about. I've been in the business for about 18 years now. I like what you call a recovering investment banker. Kind of did the whole investment banking thing for a number of years, and ultimately decided that that really wasn't for me. Kind of me and a couple other folks, we decided to kind of go into the private money route. We felt that we could add a lot more value to the retail borrower, to the retail investor. And because of that, we started Baker Collins back in 2015. As for lending, we are still lending. We are still in business. We are still originating loans in 35 states. Have we pulled back? Absolutely. Because of what's going on in the markets, because of all the uncertainty in the markets, we have reduced LTVs, essentially loan to values. We've reduced loan to costs. In addition to, we're going to require, and we've also reduced ARVs as well. In addition to that, we've had to increase some credit requirements. In addition to individuals who can provide more experience or show more experience, they're going to get a little bit better, better pricing. So things have changed, and I think we'll talk about that a little later. But yeah, we're still in the markets, financing renovation loans, new construction loans, along with commercial loans as well. So absolutely.
Sounds good.
Mm-hmm.
All right, Nate.
Hey, everybody. Dustin, thanks again. So personally, I am actually originally from Michigan. That's where the Polish name comes through. There's a lot of Polacks up there. Down here in the South, not so much. But I have been living in Atlanta for almost 10 years now. So that's personally, I'm married with 3 children, right here just north of Atlanta. Professionally, I have been in lending for about 18 years. Started in the conventional world, went into the bank side, and was in the small business, commercial, new construction, and then I've been in more so the hard money and private money side, for the last few years. So I've kind of like run the gamut, and I survived the 2008 debacle as well. Lived through that, learned a lot. And it's interesting to go through this situation as well. I think when we say things have changed, I think that's an understatement because things have changed, but I think more importantly, things are changing on almost an hourly basis. It's insane what's going on out there. And so hopefully I can give you a little bit of insight on that. I do work for Civic Financial. I'm the regional manager here in Georgia. As far as what Civic does, we are private money. Everything that we close or write or close are our programs. So we're a direct lender. There's no middleman. So we use our own money, our own underwriters, our own processors, and our own closers. So we fund everything ourselves. And then what we do is we take that money and we try to trade it on the secondary market. And that's where things get interesting, Dustin, is what's going on in the secondary market. Karen talked about, I think it was Karen that said, talked about the non-QM. It's been unbelievable to see what's happened with the non-QM market in the last 3 weeks. And we can talk about that. But as far as Civic goes, our product line, our fix and flip, bridge, 12-month, 24-month, and our 30-year programs are still fully online. We're lending. We have not had an interruption as far as funding. But as Kenneth said, we've had to make some adjustments. We've had to lower our LTVs a little bit, not substantially, but a little bit. Good news is that we have not adjusted any of the credit requirements, for our programs. But, we will require more down on purchases, and we will not leverage as high as we used to. So, that's an overview, I guess, of Civic right now. Good news is that, I guess per the market, it may not be a good, standard to set here, but per the market, we are lending at a very high capacity right now, and helping out quite a few other lenders. I think right now the difficult part for us is that we don't like what's going on, but we, certainly don't like to see what's happening to our competitors either. And right now we're kind of in a partner mode. We're trying to help as many lenders out there as possible, because the reality is that these are our friends, right? And,
Right.
and we,
I know a lot of you guys do work together.
yeah, absolutely,
Out there.
absolutely. So
Get all the
the human side is coming out with everybody right now. So
Yep.
yeah, yep.
Yep. So, hey, before we move on to the next question, somebody wrote in, I thought it was a great question. If you guys could give out your contact information real quick so they can jot it down. Nate, you go first. Nate, do you want to go first? How do people reach you?
Yeah, email is probably best. That would be Nate, Nate, dot Wolo, WOLO, at Civic FS, that's CIVIC, F is in Foxtrot, S is in Sierra.com.
All right, Karen?
So you can reach me on my cell phone. It's always in my hand. You can text me, you can call me, or you can email me. But my cell phone number is 843-247-7655. Again, it's 843-247-7655. And if you want to email me, you can do so at Karen.Hall, and that's HALL, at amerisbank.com.
And hey, while you're sitting there and the other one's talking, if you can put your contact information in the chat box, I'll share it with everybody too. That way they can visually read it and write it down.
Okay.
Yeah, just use that chat interface. How about you, Steph?
Easiest way is cell phone, call or text anytime. 678-787-9109. And also if you want to check out our website for anything I may miss over the conversation tonight, it's DFW as in Dallas Fort Worth -hardmoney.com.
Kenny?
So my direct cell number is 404-890-0569. And you can reach me also at my email, KIGWE@bakercollins.com.
All right, so my first question is, other than what's changed out there that's obvious to all of us, that we're in quarantine, we're in lockdown, there's a virus on the rampage, people are dying. What's changed behind the scenes in the lending industry that we don't know about? Nobody, we wouldn't know about it, but you know about it. And you guys alluded to some of the changes, and you were using abbreviations and things like that. Some of us don't understand.
Well, if I could,
so what's changed out there on this behind the scenes that you'd like to make us aware of before you get into details about what's changed with your company and your programs?
the biggest things on our side has really been just kind of the leverage that we offer to folks. That's changed significantly. In addition to just interest rates. And first and foremost, I want to tell everybody that, a lot of the hard money lenders that are still lending right now, they have increased their interest rates because they're trying to make up for the risk that's associated with all the uncertainty that's attached to where we're at now. And one of the reasons why we've reduced leverage is because hard money lenders, private money lenders, lenders in general, we can't necessarily control what properties sell for. And so the property that sold for $250,000 2 weeks ago may not sell for $250,000 3 months from now. We can't control that, but what we can control is the leverage that we do issue or we offer to folks. So that's been decreased. Folks are going to have to bring a little bit more money to closing to kind of make up for kind of the difference. And in addition to, interest rates have gone up a tad because of the increased risk. So your hard money lender is not trying to screw you. I had a couple of folks this week have asked me, hey man, why have you guys increased your interest rates? You guys are trying to take advantage of a situation. It's like, that's not the case. The reason for that is because we're trying to mitigate our risk as best as we can. So interest rates have increased a tad, leverage amounts have decreased. And when I refer to leverage, that's essentially the loan amount. Are we lending at 70% of the loan to value? Or we're lending at 65% of loan to value? And so those are the really biggest things that have changed on our end. And in some cases, we have increased, or we want for folks to have a little bit better credit rating. Obviously, we want to make certain that we're lending to folks that are higher credit quality folks. But we'll look at everything on a case-by-case basis. So things have definitely changed. But in my opinion, no one has a crystal ball as to when we're going to get out of this. But this is a response to what's going on in the markets. It could change in the next 45 to 60 days or so as far as getting back to some sense of normalcy. Maybe we can reduce or get back to the leverage amounts we used to provide. But as of now, that's the biggest change on our end.
So what was the loan to value before the this crisis for you?
For us, we could go up to 75% of 75% of the ARV. So we are pretty aggressive with folks for fix and flip projects. On average, we were at 70% of the ARV. 2 weeks ago, 90% loan to cost. And loan to cost, the way I define that is it's just another way of saying your down payment. So essentially, it's subject to the future value of the property. So 2 weeks ago, we were at, you bring 10% down plus origination points and fees, and we're going to hope that the property can be worth 75% of the future value. Today, as it stands today, that number has changed. Obviously, we're going to lend either 65% of the after repair value or 20% as a down payment. So things have changed because of those two things as well. So it's definitely different. It's in a different world. But I'm not going to sit here and say that's a permanent change. It's for now, it's what it is.
So did you say 65% LTV or 20%?
Correct. 20%. Correct. Either or. And we always go off the lower of the two.
Okay.
Mm-hmm.
Okay. So other than, and was that you that said the credit had changed?
Yeah. So in certain, if we're in Metro Atlanta, we're pretty fine with credit. We can be at 600 or better. Now, when we start to go outside of Metro Atlanta, because we do lend in 30 other states, now we're going to be a little more sensitive to credit because those are markets that we are not as familiar with. Now, in the Southeast, we're pretty comfortable in the Southeast. We understand, the major markets in Florida, the major markets in South Carolina, the major markets in, North and Carolina, things of that sort. But once we start to get out of those markets, that's when we have to be a little more sensitive to how we underwrite some of our borrowers.
So other than changing the credit requirements, perhaps the LTV and the amount down, have you stopped doing any particular kind of loans? Are you still doing all of the above?
So good question. The 30-year fixed loan is one that we are still being able to provide. However, that has changed for us as well. 2 weeks ago, we were pretty aggressive with 30-year fixed loans. Today, we're more so 5 and 10 one-arms. And the reason for that is because I think Nate stated earlier, a lot of our capital partners, that particular product has the 30-year amortizing over 30 years, fixed for 30 years. That particular product on our end is seen as a little bit more of a risk for an individual or entity to hold on to a note for 30 years is a lot riskier as opposed to someone holding on to for 5 one-arm or a 10 one-arm. So the rental markets have definitely changed. Obviously, that's a temporary thing. I expect for it to come back at some point in the future. I don't know when that's going to come back at this point in time. But that's one of the biggest changes for the long-term debt, permanent debt that we do offer.
Well, I'm glad you mentioned rentals. Has Baker Collins done a lot of landlord rental type loans?
Absolutely. Mm-hmm. I would say that's about 40% of our business.
Okay, because you've been hearing what's going on in the news.
Yeah.
Politicians basically saying, hey, you don't necessarily have to pay your rent anymore. I mean, if they haven't come out and said it, they're hinting at it.
Yeah. Oh, yeah. And that's
how does that affect you as the lender when the tenants don't pay the landlord and the landlord doesn't pay the lender, you, the servicer, whoever?
So everything is going to be underwritten on a case-by-case basis. That's what makes things a little challenging when you have government essentially hinting at people or suggesting people, sending folks, hey, you don't necessarily have to pay your rent for X, Y, Z. So we've been having very interesting conversations with a lot of our borrowers who actually have these loans. Now what we're doing as well is we're being a little bit more careful and we're looking into the tenants of who are moving into these properties also. And so that's what you're going to start to see as well. And I think this is a good kind of segue to the multifamily space. I know this is a fix and flip market, but one of the things that we finance multifamily properties as well, we're placing a lot of weight on the employers of that area. Who are the major employers of this particular area? Is it a area where they're going to be provided, is the major employer like a servicing company, or is it a kind of more of a professional employer? Is it Home Depot as opposed to, let's say, Walmart distribution center? So we're really looking to who are the biggest employers of those areas. But we look at those on a case-by-case basis because that is a little troublesome. We have to work through that. I don't have a crystal ball as to how we're going to get that resolved. We're going to have to give folks relief in some way, shape, or fashion. What that looks like right now, as Nate stated.
Yeah, I guess before I'm not wrapping up with you, before I move on to the next person, since I've got you, if you fund a landlord and their tenants don't pay them and they don't pay the loan, does that come out of your pocket, or do you take that loan and sell it out on the market to a servicer, and the servicer, they got to deal with it now?
Typically with rental loans, those are always on our end. Those are always sold off to the servicer. Those are always sold off to the secondary markets.
So if they don't pay, it doesn't necessarily hurt you, Kenny, Baker Collins.
It does, because we're still to a degree responsible, and because we originated it.
And you're not responsible for this pandemic.
Yeah, correct. So we still have responsibility there. I mean, we were the folks who originated that loan. We were the individuals who actually started everything. So again, this is unprecedented waters. This is uncharted. We've never been here before. So we're still trying to figure this out as we go along.
Okay. So I want to jump to Stephanie real quick because we're talking about, what's changed, what happened. You said you guys are pausing all of your loans right now, because I know with DFW Hardmoney, a lot of it's your money. And I don't think you guys sell them out to the secondary market, do you? Those loans? Don't you hold them in your own portfolio?
Yep. We do not sell our loans.
So what kind of loans typically before this pause were you guys doing? Fix and flips?
Yep. We were doing some cash out refi. We don't do a whole bunch of that, but we do transactional funding, which we're still doing. And then what I would tell people, if they wanted to buy and hold, let's say you had a lot of cash competition or whatever it was a competitive property. I'm like, use us. We close quickly. We can close and fund same day. And then, do your rehab, and in a couple months, get a tenant in there, and then refinance out of our loan. Because all of our loans were 6 months or less, right? So, you don't want hard money for longer than that anyway. The other thing too, I don't think we've mentioned yet, but we've talked about ARVs and LTV and all that stuff. And okay, let's say we adjust our ARVs 30% even, well, is there going to be an end buyer? And when are those end buyers going to come back? That's another thing we're really looking at. What's the job market going to be like? What are unemployment numbers going to be like? Yes, the end buyers will come back eventually, but how bad is it going to get? That's really the biggest thing.
A month ago, we probably had some of the lowest unemployment in history.
Mm-hmm.
And now going into this, we're going to have the highest unemployment in history within a month or two swing. So It's kind of scary. So you guys are only doing transactional funding right now, correct?
Right, correct.
And what is your transactional fund rate? Is it
1.75% or $1,750, $1,750, just depending on which comes first.
Okay. Yeah. But I know when I first talked to you about this, that was the reason John decided to pause things was he didn't know when this is going to end. He didn't know how this was going to affect the ARV. You know, right now we've got several houses on the market. I still see a few closing. We've got a couple wholesale deals closing, but our retail houses are kind of sitting there right now. We don't know when they're going to close.
Right.
If our potential buyers out of a job all of a sudden, you know, that affects their credit. They can't get a loan. It's just a weird position to be in because most of the houses we do are like under 230,000 usually. We've got a couple, maybe 350, but that's rare. Most of them are 230 and under, which is kind of bread and butter working class. And if they're out of work all of a sudden, how are they going to get financed? Are we going to be sitting on these houses for a while? Luckily, we use true private money from individuals.
Yeah.
And they're willing to wait as long as they get their interest. So, and we've got payments accrue, or no payments, but the interest is accruing. So every month that goes by, we don't have to make a payment, but it's eating away at whatever equity you have. Plus, our price is going to be coming down. We don't know. So before we get into that future value, you know, predicting the future, I wanted to hear from Karen and Nate about what's changed. So, Karen, especially you. You're in the you know, institutional funding, the big banking industry.
Yeah. A lot has changed, but it's, you know, it's changed. I think this is going to be our new norm. And I think this is something that needed to happen. Please don't take that the wrong way, but I think we needed to evolve into the new world of technology. I guess that's where I'm going with all of that. So like I said, I mean, some of our fix and flip and fix and hold and the lot loan, it's the non-QM, non-qualified mortgages. Those run our portfolio products. When I say portfolio products for us, when I say portfolio, it's our money. It's our loan products. We design it. We write the guidelines. We always follow the Fannie Mae guideline, but we kind of tweak it, you know, to fit, you know, our market. So with the risk at hand, we did discontinue those. We still have the Fannie Mae home style investor product, 85% of acquisition. Acquisition is your purchase and your rehab cost. But as far as like appraisal values, they're still coming in. We have not reduced the appraisal value by 5%. We have not changed that. All of the conventional jumbo products are still moving right along. What we have curtailed is the way we close the loans. How are we going to meet the expectation of the customer wanting to close their loans? So now we won't do e-sign, which I'm hoping will kind of go to that, but they still want, you know, ink on the dotted line, but we're allowing to do the mail-aways and to do a virtual closing. As far as like certificate of occupancy, you know, the city of Atlanta and all the inspectors, they're not working. You can use third-party inspectors, especially with all of our tract home builders. We're allowing a hold harmless to get them into their homes. Some of the other things that we're doing, you know what's really bad right now is the furlough and the temporary layoffs. That's what's really bad right now. So people that are losing their jobs, you know, you guys were talking about, you know, foreseeing the future. To me, that's over underwriting because you can't foresee what the future is going to have. We don't know what's going to happen with home values. I mean, we kind of do, but for right now, we're still holding to home values, loan product, conventional, jumbo, government loans, you know, FHA, VA, USDA, all the CRA products. Invest Atlanta is still doing DAP programs, down payment assisted programs. They're still out there. So anyone that really wants to do like a primary or a second home, and if an investor wants to do a purchase or a cash out refinance or just a rate term refinance, we're still doing those. I mean, nothing has changed there. It's just the way that we close the loan that is now changing and evolving. So, I mean, like I said, we're still trying to find solutions to meet the need of the current environment.
Sounds good. So you're not doing, did I hear you say early when you first started talking? Tell me what you're not doing versus what you were 2 weeks ago.
Fix and flip, fix and hold, and lot loans.
Okay, fix and flip, fix and hold, and lot loans. But you did say, so what we normally go to a hard money lender for, you can't do that right now.
Correct.
But you have, you said you had some alternative products that you still could do, like Fannie Mae, Freddie Mac, and some of your portfolio loans?
Yeah, well, I can do the Fannie Mae, the home style renovation loan. So we can still do some of our portfolio rehab, but not for investment, but only on the Fannie Mae product, the 30-year fixed rehab investor. I can still do that up to 85%.
So why can't you do, from what you know, why can't you do the investor loans anymore?
Those investor loans, the fix and flip and fix and hold, I mean, you know, with banks, it's always about layered risk. And so they had to curtail some of that risk factor. So back in the day, back in 08, 09, when we used to do a lot of the lot loans, and so we got left holding the bag. So let's just say you have a primary, a second home, and an investment property. Which property is going to go first? Because if we go into a situation to where somebody's been furloughed or laid off, they're going to do at all costs to save their primary residency. So that lot loan, that investment property, and that second home are the first things to go. And somebody's going to do everything they can to save their primary residency because they need a roof over their head. So
Yeah.
as a bank, it's a risk factor.
Well, it's worth saying that over these past few years, we've obviously been in a seller's market. Buying, fixing, selling. We've been selling everything.
Right.
So now that we're in this, we don't have a lot of buy and holds right now. Because if we did, we had a bunch.
How many people call me still wanting to do and buy? You'd be amazed. I've been
Well,
sending them over to Kenneth and Joe.
when the
because I
market starts to turn the other direction, when it becomes a buyer's market, we'll start buying and holding again.
Mhm.
But because it's been so hot, we've been selling. And now that
Yeah.
this pandemic has hit, I'm like, thank goodness. I don't
Well,
want to be
Mark,
selling.
Well, you remember last year the market was shifting, going to the hold market. And so now that, you know, this fear has been, you know, creeping up on us about how the renters don't have to pay their rent because they won't be evicted, you know, so now some of the investors are calling me and they're like, what do I do? And I'm like,
Well, I'm just kind of glad that, you know, we're not sitting on 20 rentals and then all these guys get laid off or decide not to pay their bills. And then we're stuck, like you just said, with 20 rentals that we're supposed to be paying because it's our loan. And then we lose them all.
I have 4, so I understand.
So are you okay? I mean, are your guys still paying you so far?
Yeah, well, I had my house in Hilton Head. The renters moved out this week. So I had a really bad experience with the rental management company there. And so I've got my guys over there cleaning it up and getting it ready. I got 3 showings on Saturday. So I'm trying to sell that property. And then my other 2, I got someone going to look at another one to go sell that one. And then I have a townhouse in Decatur. So, but I own all those. So I'm fine. No, I don't have any renters other than that one that just moved out.
Okay.
I'll never do that again.
All right, Nate. How about you? What's changed? What are you still doing? What are you not doing? What's going on with Civic?
Yeah, so Civic, if I didn't make myself very clear before, Civic is non-recourse. It's, you know, we're not a non-QM lender.
Well, tell our audience what that means, just so we're all clear what non-recourse means.
I'll keep it real.
I don't remember
simple.
saying that earlier, by the way.
Yeah, so non-recourse, we're not going to qualify the investor off of their financials. You know, their income. We're not going to ask for tax returns or 12 months worth of bank stubs or anything like, or bank statements, pay stubs, anything like that. We're going to invest underneath the entity, and the only financials that we're going to look at is to make sure on a purchase that they have enough for, you know, the purchase price, the, you know, the closing costs, and a portion of the rehab to start. Okay. So we're not going to, for us, if they're unemployed or self-employed, it doesn't matter to us. We're not going to look at any of that stuff. Furthermore, we don't report any of this on the credit report, which our investors really like. And we do not require, as long as that loan amount's under 1.5 million, we do not require them to sign a personal guarantee, which is a big, big benefit to these guys. So, you know, I'm very fortunate to be on a daily call with the 11 other regional managers at Civic with our CEO, and he's on daily calls with our capital markets group to kind of keep a tab on things. So, you know, I would have to say that I'm not the smartest but I learn a lot. But, you know, to get the insight of what's truly going on, it's similar to what Kenneth said earlier. You know, the reality is that, and this is where, Civic estimated that 95% of our non-QM competitors, and where their competitors is, of course, the fix and flip in the 30 year, they're gone. They're either gone or they've pulled funding to where they're not funding anymore. And it's happened within a 3-week period.
Repeat that again, that last part you just said.
95% of our competitors in the non-QM space is either gone, going to be gone, or not funding right now.
Funding what specifically? I thought I heard you say it. They're not funding what specifically? I thought I heard you say it.
Funding anything. They pulled funding. They're doing a pause, similar to what you've heard on this call, 30-day pause, a may not come back. And, what we're hearing from our capital markets, and we ask what has changed, everything has changed. And what we're hearing from our capital markets that deals with all of these major non-QM banks and lenders is what they're saying is that the QM space, if it comes back, it will not look the same as it was. It won't even look similar to what it looks like. That's a big statement for the guys who truly are, on the secondary market buying these loans. So, a lot has changed and continues to change. I get this question a lot of, well, if everybody, like if this is, truly affecting so many people, how are you guys still able to do what you do? And obviously we have, made adjustments to LTVs, and I'll go into that in a second, but we're very fortunate to be a daughter company of a larger company. And they've been around for 35 years, and they still have those relationships with their capital markets partners. And we still have that solid relationship and funding to continue to do what we're doing. A lot of the lenders out there and banks out there just simply don't have the liquidity to stay relevant right now. And unfortunately, that's what you're seeing. Kenneth was exactly right. The reason why you see rates going up right now is not because we're trying to stick it to anybody. It's those secondary markets, the buyers on the secondary markets, i.e. the banks or larger capital investors, aren't buying paper at 4.5% and 5% and 6% that these non-QM 30 years were being written at. They're buying it now at 8 or 9. And so they can't sell that on the secondary market. If you can't sell it, well, what happens? That lender's stuck with that paper.
Yep. Well, somebody just wrote in, because you guys are throwing around some industry jargon that not everybody knows what it means. Someone wrote in, what does QM mean?
So QM means qualified mortgage. So non-QM means it's not qualified mortgage. So like for us, everything's conventional in government. And so everything has to be documented on my side with the HER, which means ability to repay. So okay. Nate, do you want to describe it from your side?
Yeah, absolutely. Oops, sorry, did I lose you guys?
Nope. Just so you know, whoever's talking, the screen will get real big.
Okay.
So when Karen starts talking, she'll get big.
Okay, I apologize to everybody when my screen gets big. Nobody wants to look at that for an extended amount of time. So yes, so the qualified mortgage, so the non-QM, this came out of Dodd-Frank back when everything hit the fan in 2008 and 2009. The non-QM started to come on board for those self-employed people that couldn't qualify for a qualified mortgage. Likewise, I think we saw the rise of private money and hard money at that point. And I do agree with Karen when, and this doesn't, I know we may sound mean when we say this, but anybody who's been in this industry for a while, we needed a correction. When we really took a step back and looked at this with a realistic viewpoint, we're thinking, oh my gosh, like we're leveraging these properties so high, and we're not requiring much down, and we don't even know if we can get paid back here. Everybody's rolling costs in, and the amount of liquidity became less and less and less. So we were getting very aggressive in the non-recourse and private money space.
Yeah, let me ask you about that before we get into some of our questions that are coming in. I've noticed as a REIA leader over the past couple of years that there's more and more hard money lenders have been coming through our doors, and they seem to get very aggressive getting down into the, the interest rate in the single digits, 9.999. So you said we needed a correction. Why do you say that? Because as more and more people were getting into that space, it was getting more competitive, and you needed to shake it up and get rid of some of the folks? Because you said 95% lending right now.
I kind of liken it back to back in 2008 when subprime hit the market, and we're like, wait a minute, we're giving 100% financing to people that just came out of bankruptcy with nothing down. What is going on here?
It was too rogue. It was just, everyone was just
exactly
throwing money around. And I'm like, here we go again. And everyone was like, Karen, don't you know the subprime market's coming back? I'm like, no, it's not. We're not. I mean, we dipped our toe into the investor circle, this past 2 years, with the fix and flip and the fix and hold, and it's going very well. But when something like this happens, we have to curtail to protect the bank and our liquidity so we can keep lending to, to the real estate market.
Exactly. I would wholeheartedly agree with that. And so I think what you're seeing now, Dustin, is a correction back to traditional hard money, where you have to have liquidity to get into the game. You have to have in the game. And that's just kind of where we are right now. And I don't think it's a bad correction right now. I know it stinks because a lot of new investors trying to get in that don't have a lot of liquidity, they may be, they may not be in the game to purchase right now, but, lenders were just getting, in my opinion, way too aggressive.
Properties. Back in the day when I was young in the business, if you didn't have the money to put down, you had to go out and do a few wholesale deals and raise the money.
Yeah.
Exactly.
So
and that's where we are. That's where we are right now. So, so that's kind of what has changed. Now, what has changed for Civic? I'll speak specifically for here in Atlanta, and then in Tennessee and South Carolina, Florida, which is, where I think most people are right now. Yeah. So here in Atlanta, before this, about a month ago, we would leverage properties usually up to 80% of the loan to value. We have taken that back on purchases to 75%. Okay. On refinances, we'll go up to 70% of the LTV. And that's on purchases and or refinances. Florida, we're going down to 65% mostly just because of, the obvious risk there with weather and problems in Florida. It's just a riskier state to lend in. Tennessee, South Carolina, North Carolina, you're going to see in between 70 and 75% right now loan to value. That'll hold true on the fix and flip as well. But, we're going to figure out our, leverage off the purchase price first, because we take it as we want to make sure that we have equity in the property before renovations even start, because we know that once the renovation starts, that property is going to get decreased probably 20 to 30% in value. So if we do have to take that property back unrenovated, we at least know we'll break even without a loss. We don't go off the total cost. So what we'll do is we'll figure that out first off the purchase price, and then based off the investor's experience, we'll figure from 80 to 100% of the renovation.
Okay. And that was one of our questions that came in from Neil Kalansky. I'm butchering your last name. I apologize, but he wanted to know what your ARVs were versus what they've adjusted down to. So you just mentioned a couple. If you want to repeat them real quick in like a sentence or two, and then we'll go to Kenny and the rest.
Yeah. So ARV is different than LTV, but it's going to be very similar to what Kenneth.
You know what? He did say ARV. I'm thinking LTV. He did say ARV. My bad.
So ARV, we went from 75 down to 70.
Okay.
Yep.
So he was doing 75% of the ARV on rehabs down to 70. Kenny, I think you said you were at 75 and you're down to what, 70 or 65?
Yeah, we were at 75%. Now for folks who if you have a 680 credit score, we can go up to 70%. But for most folks, we're going to be at 65% of ARV. So we're kind of going back down a little.
That does sound like normal, old school
hard money as well.
75 sounds crazy.
Yeah.
We won't even do a purchase at ARV. It's all acquisition.
Yeah. Explain that to the folks in the audience real quick, if you don't mind.
Okay. So the difference between a purchase and a refinance. So when you purchase a property, let's just say you want to do a straight purchase. So it's the lesser of the two values, either the sales price or the appraised value. So typically On a Fannie Mae product, you can get 85% financing with a little bit of mortgage insurance, but you have to put 15% down. So if it's a $100,000 loan, you got to put $15,000 in. It's a higher rate at 85, like 5.25. Then if you go in at 80, still 5.25. And if you do 75% financing, 25% down, that rate drops to like 4.5. And we don't charge any points on those rates. And then if you want to do a refinance, a rate term, meaning you're only refinancing what you owe on the property within 6 months, then it's based on still the sales price. And then you have to own the property for 6 months in order to use the new ARV or the new appraised value after owning it for 6 months. And if you want to do the cash out refinance, where you pull out equity to pay off everyone else that you went around to borrow money from to finish the property, then that is when you're going to have to wait the 6 months in order to do the cash out, and that's based on appraised value or ARV.
Okay. How about you, Steph? What were you guys loaning at as far as the ARV goes before this happened, before your pause? What was it?
Yeah, so we were up to 75% of the ARV and 100% of the rehab, but that was in the form of a holdback. So I don't know, for anyone listening who hasn't done a hard money loan, you'll get paid for your rehab budget in the form of reimbursements. So that will be part of your loan amount, but what it'll look like is you'll go pay your contractors, get some of the work done, and then whenever the work is finished, you come to us and say, hey, I got my flooring done. It was 10 grand. I need 10 grand in my holdback. And then we would reimburse you the money.
Hey, panelists, I noticed you guys are sending a few things through the chat interface. Right now, you're only sending it to each other because you get it set to all panelists. If you want the audience to see what you're chatting out, there's a little arrow will drop down. You got to change it to all attendees.
Thanks. Appreciate it.
Yeah, because it should say all panelists and all attendees, because I see you sending me stuff, but they're not seeing it. I know you want them to see it, so just copy and paste it and resend it. Okay. So Stephanie, you guys are on pause right now. I know you've been talking to John. We're going to be in this lockdown until the end of April. Your pause will be up about halfway through April. Are you guys going to continue pausing, or are you guys going to take this time to kind of regroup and maybe change your rates like some of the folks on the call are doing tonight by dropping that ARV, increasing down payment?
Yeah, we don't know yet. I mean, DFW, for instance, just extended their shelter in place till May 14th.
Wow.
Yeah. So, and I
know Governor Kemp, I think here has got it to the April 15th, but that's probably going to be extended to the end of the month, at least.
Yeah. I mean, at least. So, I mean, May 14th.
Wow.
I mean, that's a long time, and that's a long time for people to not be at work. You know, that's a long, I mean, we really don't know yet. We are not out of this, and we're not even close.
Yeah.
So.
Well, hey, are you guys all staying home and sheltering in place? Are you guys going out and trying to do business as usual? I'm just curious real quick.
Just to the grocery store.
Yeah. Me to the package store and then to the grocery store in that order.
Yeah.
I don't even do that. I just stay right here in front of my computer to like 7:30, 8 o'clock at night. And then I go downstairs, eat dinner, lay out on the couch, and then I get up, go to bed. That's it.
Yeah.
I'm boring.
But you have been staying in. Yep.
Yeah, absolutely. Well, my mom lives with me and she's 77, so I cannot risk her getting sick at all. So I just stay home. I haven't driven my car in 3 weeks. Actually, I went up to Roswell a couple of weeks ago just to go check on one of my rehabs that I'm funding and just to go get out of the house. That's about it.
Yeah, I'm taking this a lot more seriously than Chrissy is. And like I said, I leave the house maybe twice a week just to go to, like I said, the package store and the grocery store and back.
Yeah, my mom goes to the grocery store, but she wears her mask. And actually one of my girlfriends, she does like high-end corporate gifts for the Falcons and Atlanta United for Arthur Blank and his foundation. So she's now deciding to make the mask for all the collegiate the Falcons and the Atlanta United. So, because this is going to be, moving forward, this is because
Yep.
we just don't know. You don't
In
know what
fact,
you got.
Trump, I think just today started to recommend that people wear their masks. It's not required, but he's recommending it. But
I don't think the government should have to warn you to wear a mask. I mean, I think you should do it. If you feel like you need to do it, do it.
I mean, what's it hurt, right?
Right.
But I went to the package store the day before yesterday and walked in. I don't have a traditional mask. I have what's called a neck gaiter, and you can pull it up over your face or turn it into like a hoodie thing. And I walked in with my black mask on. Yeah.
Did you see the woman on Facebook, and she was covered in black plastic trash bags and duct
I've seen a
tape?
lot of those.
So my comment was, Richard Simmons sweating to the oldies.
Yeah. So I walk into the package store, and the cashier turns around and looks at me.
Yeah.
Funny look, like, was he going to stick the place up? Then he turns around and looks at the line ahead of him, and everybody in line was wearing these same type of masks.
Yeah.
So I was kind of amused. I thought I'd never walk into a package store with a mask on,
I know.
or something.
It's kind of scary. Well, once they kind of, get a control on it and, get a vaccine and, get everything they need to do whatever it is they need to do with it, then I think everyone will kind of, go back to normal a little bit. But I still think that social distancing, and I don't think people are going to swarm back out to the restaurants. And, up in Marietta at the old Radisson, the CDC took over that hotel and made that the quarantine hotel right next to my office. So I'm like, I'm not going back to work. You can
No,
forget.
I didn't know that. Right, so let's get to some of these questions that are coming in from our audience. And you can click on the Q&A interface. I'm not necessarily asking these in any particular order. I'm just kind of going through them. This one is from Mark Carusco. It just says Mark C. He said, I understand that Georgia, according to Clark Howard, has not adopted to hold off evicting tenants. Other major states have stated to hold off any evictions. That means that landlords have the ability to evict in Georgia unless something has changed in the last 2 days. So to address Mark's question, you heard on the news for the past couple weeks that we're going to put like a moratorium on foreclosures and evictions. Well, I heard that the only power the federal government has to make such a moratorium is only for like Section 8 type rentals and maybe Fannie Mae, Freddie Mac, government-backed type loans. I don't know if that's what I just said is true or not, but what do you know about the moratorium in Georgia specifically, since we're here in Georgia, about not being able to evict and or foreclose? And by the way, are the courts even open to do evictions right now and foreclosures?
Oh,
Go ahead, Nate.
I don't think they're open. I mean, based off of just our inability to get tax info from city and county offices, nothing is open right now. So I don't think that the courts are open. I could be wrong, but I haven't visited them lately.
I mean, I just can't see a bunch of people sitting down at the courthouse with all this going on. And I can't see them getting much done from home.
Well,
So
that's another point
I'm
that
under the impression they were closed.
people aren't really talking about that either. What the backlog is going to look like when we go back to whatever normal is going to be after this. What's the backlog of getting properties closed going to look like with the counties being shut down for so long?
Yeah. I mean, what's today? Today is the
We'll do online title searches and online.
yeah. Today is the 3rd. So when's foreclosure Tuesday?
It was the first Tuesday of the month.
That's the 7th.
So it was,
Are they having it? I don't think so, right? So
I
Mark,
guess not. 7th, yeah.
yeah, so Mark, even though it's technically, they may not have technically shut it down, if they're not actually having a sale at the courthouse steps, it's essentially shut down, right? And if eviction court's not meeting right now, I mean, they don't want people down there, showing up to defend themselves.
So I just found online at fool.com, and it says Georgia, no statewide eviction moratorium is in place at this time. But Atlanta Mayor Keisha Lance Bottoms has issued an executive order pausing residential evictions and filings for 60 days.
Okay, so you hear that, Mark? That is for the city of Atlanta. I'm out in Gwinnett, and I don't know if that, what she says doesn't affect us here. But
Right.
again, I don't think the courts are open to evict anybody anyway.
Yeah, and I did read somewhere along the way saying that they were going to hold everything off until May 1st.
Okay.
So I don't know if it's or not.
Yep, and it may be longer than that. We'll have to wait till we get to the end of April and see, but it could be for a few months, Mark. Well, that was a great question, and sounds like none of us really know, other than the courts may be shut down right now. So let me read this first. This came in early in the call. Let me put my glasses on so I can read it. Here we go. This is from Lynette. Florida listed as a sheltered state, already getting lenders saying they're not lending here, like United Wholesale Mortgage, UWM. How long do you think they can last without lending to everyone? And just to kind of follow up on her question, some of the things you guys were saying earlier, we know that a week or so ago, the Fed lowered the rate to like nothing, 0, to get lenders to want to lend to people. You guys said you were raising your rates even though they lowered their rates because of your risk. But kind of address what I just said about them lowering the rates. And her question is about Florida specifically. You said yourself, Nate, I think 95% of the people aren't lending right now. Why not? And how long can that last? That's her question. It was the first.
Yes. So, Kenneth, go ahead.
Yeah, I wanted to address that because one of the questions I tend to get quite often is, I heard the Federal Reserve cut rates, and so why are your rates going up?
Yeah.
And so we have to explain to people, well, our rates, the Federal Reserve does not create mortgage rates. The bond market creates mortgage rates.
Yep.
The bond market is full of nothing but investors. It's another pool of investments. And so with those investors, whenever there's some type of uncertainty or major uncertainty, there's nervousness, there's apprehension, there's trepidation there, they start to raise their rates. And so that's the reason why our interest rates have gone up, because of the bond market and the folks that we tend to, in some cases, sell our monies to. But to answer the question, the other question as far as will those lenders come back or relend again, eventually, no one has a crystal ball. I don't know. I don't think they know when they're going to do it again. We're looking for, and I would assume, and again, this is my assumption, that they're just waiting for some type of normalcy to come back. Whether it's the stay-at-homes have been lifted or something along those lines, they're going to have to start lending money again, but we just don't know when that's going to happen. But, it also just, there's a number of things there as well. Their operational expenses, how tethered are they to risk? And there's so many reasons as to why they could have stopped lending. And sometimes, it can go a little more deeper than that. Maybe they have investors that are very uncertain about that as well. So the answer is, we just don't know when they're going to start lending again, because we don't sit on their investment committee and we're not giving them advice as to how they're going to go about doing that also.
You heard Nate mention that 95% of the lenders out there aren't lending. How
Correct.
long can they sit there and not lend and stay in business? Are they going to go out of business, or are they just going to sit on the money? How does that work?
Some of them are going to go out of business. I'm sorry. Go ahead.
No, go ahead, Ken. Go ahead.
Yeah, some of them are going to go out of business. I mean, at this pool, I think everyone can agree that there are lenders fall in 3 categories. There's a group that has suspended lending. There's a group that does not have any money. Then there's a group that they've just changed how they lend money, whether it's changing of loan to values and loan to cost. Some of the folks that we've spoken to over the last couple of weeks, they have, they're not coming back. There are some major players that will not come back. And it's going to look much differently than it will look as it looked 2 or 3 weeks ago.
Why aren't they coming back? Did they have their credit lines pulled or what?
Credit lines pulled, a combination of things. Credit lines pulled, and also just the operational expenses of running a fund or running a company. When you have a staff of a couple of hundred people, you have a certain amount of money to use. Yeah, I was on the phone with, won't name the name, but they're a fairly large commercial real estate lending company. And the guys told me that he was on the phone with one of his buddies and just told him he just got laid off. This was a company that I would have never thought in the last 5 years would have gone away because of this. It's the operational expenses that are kind of not allowing some folks to carry on. It's one thing to have a pool of monies to lend out of, but you still have to manage and make payroll and advertising and marketing and human resources. And there's a lot of things that have to be taken care of. And if you don't have revenue coming in, that's going to hurt your bottom line to the point where you may have to just suspend or just stop the business altogether. But again, that's what we've seen on our end. That's why some folks are just not going to come out of this. But some folks will come out of it, but it'll definitely look differently.
Yeah.
Yeah, Kenneth is exactly right. And when he said, revenue coming in, well, how do these lenders get revenue coming in? Well, they batch these loans together, right? Sometimes at 10 to 20 to $100 million worth of loans, and they sell it to the secondary market. Well, if these loans are leveraged so high and the rates are so low, and something happens in the market like the coronavirus that scares the markets, they can't sell this money to the site. It won't move. So that lender is stuck with this $100 million worth of loans. And I think we all would be very surprised, even the biggest lenders in the nation, they're very low on liquidity. They don't have a lot of capital. And so they're stuck with putting that $100 million on their own portfolio. They can't keep that there for very long. And like what Kenneth said, if they're forced to keep it there, which they are now because this paper is not moving on the secondary market, they're going under, because eventually that $100 million is going to be called by their capital markets, meaning they want their money. And if they can't meet that call, they're done.
Yep.
Their warehouse is pulled or substantially slashed, and they don't have any way of bringing in new revenue. And they're stuck with this batch of loans that they just can't simply get rid of.
I heard something interesting the other day, and I read it in the news. I'm going to try to paraphrase it. It was about the servicers, the folks who service the loans. Suddenly, all the mortgage holders fall behind or stop making their mortgage payments. I heard the servicer, the person who services that loan, that company, still has to make payments to the investor that bought the note, that bought it. And the servicer has to pay it, but the servicer only has so much money liquid, like you just said. And the service industry could go bankrupt. The ones who are servicing the loan could go bye-bye.
That's true. That's very true. Especially, I could go on and on and on about all of that. Now we got the whole thing about the forbearance that people don't want to make their mortgage payment, for 90 days, so there's a lot of, conflict about that right now. So, I submitted my request to Wells Fargo. I wanted to see what they had to say because I want to know. I'm that type of person that wants to know. So if I don't make Wells Fargo, right? And if Wells Fargo doesn't take my mortgage payment on my houses for the next 3 months, times how many millions of people that are doing it, right? So then what happens in the end? So either A, I have a choice to catch up and pay that 3 months. B, I have a choice to stack it on top of my current principal balance. Or C, you go further into a modification to adjust your mortgage like we were back in 08 and 09. But if I don't pay Wells and Wells doesn't have enough liquidity to pay the servicer, or the servicer doesn't have enough to pay the investor that holds that note, then they're going to go under. And it's just going to be a domino effect.
Exactly. That's what's kind of scary, and what most people don't know about. I didn't know that until I read it in the news.
Same way like with these interest rates, these interest rates and having margin calls. You guys do margin calls? Hard money guys?
Oh, yeah.
You do? Yeah. So it's like margin calls is the same thing. So, here we are, I'm getting all these refinances in the system and I'm gambling the market. I'm telling my customers, get your loan in the system. When that rate hits, it hits for 2 hours. 2 hours. And those rates are right back up. So I'm on the phone with my customer, dialing like a maniac. You want to do it? And we're going through this whole conversation. And I'm not being rude, but I'm like, I don't have time. Do you want it or do you don't want it? I got to move on to another customer that does want it, Yeah. So some of them, I just lock the rate and say, hey, I locked your rate in. If you don't like it, I'll do negotiation. Yeah. But what happens is when we lock in that rate, that low rate, let's just say I lock in a purchase at 3%. I've been doing that. They're currently at 3.25. So the purchase rates are great. It's the refinance rates that are not good. So if I lock in at 3, and then the rates go up to 3 7/8, 3.875. And then the investor does a margin call. We got to strike a check before that loan is even closed. So there's no extension of the lock. There's no renegotiation of the rate. We got to close that loan and close that loan quick and get it off our books and get it over to the investor. And if you don't have money for a margin call, striking a check to the investor, that's even another, whole ball of wax that people just don't know about.
That's how lenders go down. Yep. That's the point of no return right there.
Yeah. So that's what I said. I'm happy I work for a bank that has liquidity and we have a lot of money and we're strong. So I'm happy about that. So we do have money and we are lending.
All right. So, well, let's talk about that because this next question came in from Champ Buys Houses. He said, we're seeking refinance cash out loans for our BRRRR deals in Georgia and Florida, BRRR.
What is that?
It stands for buy, rehab, rent, refi, repeat. So
you owned it 6 months, I can do a cash out refinance with a pay stub W-2 and a 2-year tax return.
Yep. So the rest of this question says, we're running into issues locating lenders that will provide 30-year loans to LLCs. Any tips?
We do not lend to entities. The mortgage industry only lends to individuals, and we do report to your credit, and you do have to personally guarantee the loan. Now, after you close, you can deed it into your LLC, but not during the process.
If they deed it to their LLC, will that trigger the due on sale clause?
No, that was like before 2010, and so nowadays underwriters are like, yeah, they can do that. That was back in the day.
Okay.
So
how about
Dustin,
the rest of you? Are you guys doing any kind of refis for these buy and holds?
So
30 years?
Yeah, so we do quite a bit. Our 30 years is still doing quite a bit of business. So we'll usually cash out, and again, we don't need the financials. We're just going to vest underneath an entity. We'll do cash out up to, depending on where it is, usually between 60 and 70% of the as-is value of the property. If they have completed the property, that's fine, no big deal. We don't have any seasoning as long as the renovation has been completed. And that would be on a 30-year. Here's what I'll say. What I'm seeing right now, though, is it's a bridge market. A lot of investors are just, are doing the bridges because they feel like the market's going to come back and they'd rather refinance into a 30-year at a lower rate 6 to 12 months down the road. Now, is that hedging bets? Sure, it is. Absolutely. But we can do that. We do it all the time. I got a lot of investors that are pulling cash out of their free and clear properties to buy a bunch of properties right now. So we can do that. That's not a big deal. We can also portfolio loans up to 10 properties at a time underneath one loan. So, we do have that ability to go up to 60 to 70% right now. Cash out.
All right. How about you, Kenny?
Same here. And I know this is one of the, I 100% agree with Nate as far as it being a bridge market, although we can finance long-term rentals specifically for LLCs or entities. It is a bridge market. A lot of our clients are kind of wanting to hold off on getting a long-term rental because they've seen some of the interest rates that are attached to some of the longer-term permanent debt loans. 2 weeks ago, we were able to get someone a long-term rental, 75% leverage, almost had a 5.25% rate. Now, obviously, Karen is probably going to that's not a great rate for private money for a conventional loan, but for a private money loan, that's a fairly decent rate at a 75% leverage. Just a few days ago, he actually came back. The same individual came back into town, and he told me to hold off on it. He was, really good guy, but just a little arrogant. Thought that nothing was gonna change. Came back into the market. That same 5.25% rate at a 75% leverage, 75% LTV for a 30-year fixed is now 875. So it's jumped up 250 basis points because of the fact that, that's what 2 weeks will look like, especially within a market like this. So yes, we do that. We can refinance it, but it is definitely a bridge market. Folks are hedging their bets. I've shared with folks what we can do for them on a bridge and then what we can do for them on a long-term rental. Many people are like, look, I'm going to just take my chances. I'm going to go for the bridge, Hopefully the market comes back. Hopefully interest rates are going to be reduced in some way, shape, or fashion. But you know, and it's a no prepayment loan, so I'll take my chances on taking on this bridge as opposed to locking into a 5/1 ARM 30-year fixed loan or so. So yeah, that's something we can do as well.
Hey, Dustin, on just on top of what Kenneth said, and Kenneth, I really appreciate, you know, it seems like we're tracking here, man. It's,
yeah.
You know, one of the other issues with the long-term debt right now is these properties just aren't, they're not qualifying in the debt service because the interest rates have gone up so high, you know, per what the investors want to borrow to what they're actually getting for rent. They're above, for us anyway, our standard is 1.0 debt service coverage, and they're not covering that. So right now the rental program, just the 30-year programs just don't qualify because rates have gone up 200 to 300 basis points. So that's another issue. And that's why we're kind of transitioning right now into a bridge program, because the bridge doesn't care about the debt service coverage. You know, that's the easiest program to kind of qualify for right now and get that cash. And investors are like, well, give me the 11 and 12% interest rate. I'm going to jump on these properties because nobody's bidding on them right now. And that's what we see.
Yep. All right, this next question, we got about 20 minutes left to get through some of these questions so we can get you guys out of here on time. This question is from Arnesha Mobo. I hope I pronounced that correctly. Can an investor refinance a hard money loan? If they can't sell the property, how do they get out of the loan? And the reason I ask this is because Stephanie mentioned they've got a 6-month loan. And what happens if you're not done and sold by then? We've got a couple right now ourselves that we put on the market, and then this happened. One's down in the city of Atlanta, one's over in Decatur. They just got listed, then this happens. So it's not that we can't sell them, it's that we haven't sold them. And you've got, I mean, how long do we go before we need to refinance them? So that was her question. Can you guys do a refinance? I think I heard you say earlier, 60 to 70%.
Yeah, it's very common. Very common for us to refinance that, extend it another 12 months. With the bridge, you can have it up for sale, for Civic anyway. We don't care if it's up for sale and listed, that's fine. We don't have any prepays, so if we extend that loan another 12 months, which benefits the investor, because when those loans mature, usually you're looking at a max rate and extra points on top of that. So we will come in and refinance that. And if you by chance get a bid at closing and you close 30 or 45 days down the road, good, great. We don't penalize you for that. That's fine. So yes, we do that. The biggest thing though is that we're finding that these properties are over leveraged. So we're having a hard time keeping these refinances under that 70% mark. So if you're over 70%, just be prepared that you're going to have to come in with that money at close.
Yeah, similarly, we can do that as well. Just want to kind of, I have to share this with you guys. And I think that's definitely a good strategy. We do that quite often. But if it's a scenario where you need to get out of a private money or a hard money loan and you're looking to get into a bridge loan, you want to do some very simple math. You want to try to figure out, is it going to cost you more to stay into this private money loan or hard money loan? Maybe figure out what your extension fees are going to be, as opposed to refinancing in this situation with either myself or with Civic or with Nate, because you really have to figure out which one's going to cost you more. In some cases, it will be less if you just pay the extension fees for the private money or hard money lender that you're in, and just kind of hopefully you'll be able to sell the property or exit out of the property within a certain time frame. In some other cases, it may be prudent for you to just go ahead and refinance into another bridge loan, which gives you another year of flexibility, another year of no prepayments, another year, possibly even a lower interest rate. So it really comes down to your numbers. You got to really do some homework as to what your numbers will be. Ask the private money or hard money lender that you have a loan with and try to figure out, what will my extension fees be? And if that number is going to be significantly more than what it would cost you to refinance into a new debt, then certainly that's another option. Just something to keep your eyes open and think about that as well.
Your sound's turned off, Dustin.
To follow up on that refi question, That's because Chrissy was in here. I muted it. I forgot to unmute it.
Tell her we said hello.
I will. This is from Alicia Coley. She was saying, if the borrower, and you kind of sort of answer this, but it's worth repeating. If the borrower is looking to do a cash out refi, are there any seasoning requirements? I heard Karen say there was a seasoning requirement.
6 months.
If any of you guys want to repeat the seasoning requirement on a cash out refi, please do.
Yeah, so for the bank, so we do a 6 month seasoning. So from the day that you purchase, we can put the loan in process in like 3.5, 4 months, and then, start working it that way, but you cannot close until the day after your 6 month anniversary. You do a cash out refinance. And I do 75% of appraised value. And the rate's like 5.25, no points. Unless the rate's, messed up and Fannie Mae has points on the rate, but we don't charge any origination fees or discount.
All right. How about the rest of you?
So we don't have technically any seasoning requirements, but if it's owned within a 12-month period and there's been no work done on it, we're going to go off of the purchase price, not the as-is value. Now, that being said, if they've bought the home, done work on it, and completed it, we will go off the actual as-is value. So I've got a lot of guys that will buy the property, fix it up within 2 months, and then, refinance, and we're going to go off the as-is value. As long as that renovation has been completed and they can just produce a budget, we're fine. We don't have any seasoning requirements.
Yeah, we don't have any season requirements as well. Not for a cash out. It's just, if it's a short-term bridge loan, there's no season requirements. We want to make certain that as long as the value is there, we're going to go off of the as-is value of that asset.
Yeah, we don't do seasoning requirements either for the occasional cash out refis that we do. One of the advantages of working with us, though, when it does come to like cash out refis and really anything that, comes across our desk, it's pretty subjective to our in-house appraisers. All three of my owners are licensed brokers, so it's kind of up to their discretion what we'll do at that point.
Okay, this looks like it's a question for Karen from Mark Anthony. How many months reserves does Fannie Mae require? Also, does Fannie Mae require tax returns and W-2s?
The reserve requirement for a primary is 2 months, and for second homes like 4 months, and for an investment property is 6 months. And that's on all your investment properties. You can have 6 months reserves. And then what was the other question about 2-year tax returns?
Yeah, does it require tax returns and W-2s?
So if you are a pay stub in W-2, then I'll just use your pay stubs in your W-2 unless you have REO and you have it on your Schedule E. Then I'll get a 2-year tax return, and we just use the most current year for your rental income and calculate it that way off your Schedule E.
Okay. And Mark wrote in and said that the foreclosure sale for at least for our area has been canceled until at least May. All right. This question's from Zipporah Jackson. For Kenneth's company, is it all based on your personal or business credit of 680?
So that's a good question. Let's do away with the term business credit. With us, we will eventually lend to the entity. And then, as Nate said, there has to be a personal guarantor in many cases for us. And we're going to go off that individual's personal credit score. We do not, nor have we ever, I don't think we will ever will, use someone's business credit to qualify them. So it will always be their personal credit, but they will have to be, but the borrowing entity will be the entity they set up, but they'll be the personal guarantor for that property.
All right, this question is from Mark Anthony again. If you're stuck in a fix and flip at high leverage, what are my exit options?
Ooh.
I saw your eyes getting big.
So I hate to say this, but whenever I get guys that are in this situation, unfortunately, I get I'm seeing more and more of them. Finance-wise, there's nothing much we can do. I can't do anyway institutionally. you know, sometimes, I hate to say this, but you just got to kind of grit your teeth and sell and maybe break even. Just try to get a deal. Yeah, that's a tough one.
Yeah, because he didn't really say, he said high leverage, but is that hard money? Is that money that you have into the deal? Is that traditional funding? Is that private money? You didn't really say what kind of, high leverage it was. It would kind of depend on the loan.
I would say nowadays high leverage is anything above 70%.
Yep. But depending on who holds the loan, depending on who holds the loan, there's some things you can go back and maybe negotiate with your lender if it's private money, especially.
Yes, especially if it's private money, yes. But institutionally, those guys usually don't.
Institutionally, cash for keys.
It is what it is, yeah.
Deed in lieu. But if it's private money, you can go back and renegotiate with your private lender. Yeah. But you heard what these guys said about cash out refis. It's 60 to 70%.
Who said deed in lieu?
I said deed in lieu. I mean, if you can't afford it, if you don't want to get foreclosed on, you can deed it back to the bank.
Well, I'm going to tell a quick story real quick. I know we're on short on time, but I had a customer call me and she was like, Karen, she goes, I need to refinance. I need more money to finish the rehab because she didn't do her calculations correctly. And I'm all about calculations, right? Constantly. And so it was a hard money lender that referred her over to me. And so after I looked at her credit and I said, sweetie, I said, how in the world are you making these payments? She goes, oh, I've been using my credit cards. And I'm like, you're doing what? And here I am, the banker, the straight and narrow banker. And so I picked up that phone and I called that hard money lender and I said, what did you do to this girl? I said, you put her into a financial hardship. She was so underwater. And I said, you got three choices: foreclosure, bankruptcy, or just sell them for what you can. I said, those are your only choices. That was it. There was no way to bail her out of that.
Yep. And
I think the properties were in Decatur. That was even worse.
Yep. So depending on what kind of loan you have, I mean, does it have a balloon on it? You didn't say, Mark. But a lot of times, if you're asking what your exit strategy is, if you can't sell it for what you owe, you're going to have to write a check at closing if you sell it. Otherwise, you could rent it. You could Airbnb it. Because we've got several of our members who got stuck with rehabs, very nice rehabs. They put a lot of money into them, but they just didn't sell. One was like $800,000 house. One was like $500,000, kind of in the hood. The street wasn't the right street. Another street over probably wouldn't have been better. But one's doing, the one that's got the $500,000 house in the hood, I say the hood is not that bad, is turning it into a HUD Section 8 rental, a $500,000 Section 8 rental. The other gal, and this was, by the way, the topic of last month's Flip Chicks. It was good deals gone bad. And what do you do about it, Mark? So the other gal with the $800,000 house down in Decatur on DeKalb Avenue, I believe it was, turned it into a Airbnb and was doing quite well. I don't know how she's doing now that this is hit, but she was doing well before the pandemic, and that was a month ago today. So I haven't talked to her about that since, but I don't know how it affected her because she had some, I think some longer term people in there. All right. So this next question is from Atasha Murray. Will the banks lower business lines of credit or credit cards like they did in 2008? So they're going to start cutting back people's credit lines and credit card.
Well, that's kind of where I was going before about the over underwriting piece, so you have to underwrite and you have to in current market condition. So if your credit card companies, American Express, Discover, MasterCard, Visa, if they start feeling the crunch, we had 10 million people file for unemployment, I would highly anticipate that to happen. It's not unlikely for it to happen.
Yeah, I'm not surprised.
If I can touch on that, one of the things that we ask for every client is we want to see, we don't necessarily need tax returns, we don't need employment verification, we don't need income verification, but we do look for bank statements along with cash equivalent accounts. And one of the questions I get asked a lot is, hey, will you use my credit lines that I have with XYZ Bank, financial institution? And I always tell people, unfortunately, we can't do that. And so their response, then people get a little upset because when I tell them that we can't do that, and the reasoning for that is exactly what Karen said. If you read the fine line for any type of credit line that you do have, it is to the sole discretion of the bank, the issuing bank, that they can either reduce that line or do away with it altogether. And so that's the very sole reason why we cannot use credit lines to qualify someone for our particular loans. So that's a very good question as to what you just asked also.
Yeah. You give people too much line of credit, it's going to be over leveraged.
Yeah.
Okay.
So for Civic, we still will use home equity lines and business lines to qualify. However, this is changing overnight. And for example, we used to use 401ks too, but because the market dipped so much, we're no longer accepting 401ks to qualify. So everything in this industry right now, and this is, I think, everybody on this call should know, is that this situation is so fluid that, speculation gets thrown out the door in an hour. We don't know what's going on. And we're just trying to, play defense as best we can because it's happening so quickly. But what I can tell you is that, these guidelines are not going to get any more conservative. We're going to tighten up even more as this thing continues. So I would expect for us to probably pull back on those lines too. Eventually, we have not made that change yet, but I have a feeling it's going to come.
Okay, I've got time for maybe two more questions. This first one is from Mark Anthony. Again, I want to keep the answer short because I want to give you a little bit more time for the next question. Mark asked, what are your terms for short-term rentals such as Airbnb? Any of you, do you guys do are you currently doing any kind of long-term holds for people that want to do Airbnb?
We do not qualify. We do not qualify for short-term.
Yeah.
Because of times like this, it's just too unstable.
Yeah, I just do it based on long-term rent. So what you do after the loan closes is totally up to you. But if you want to do an Airbnb, I can't do anything with that unless it is on your tax return as taxable income to use it for qualifying income.
Okay.
Yeah, same here. Like with us 2 weeks ago, if you had asked me that question, yet we were able to use Airbnb income to qualify an individual. We'll just use that and determine your market rate, and that allows us to use your debt service coverage ratio. We can't do that right now. There's one of the things about recessions, I don't mean to throw that word out there, but it really affects the travel industry, and that would be really challenging for us to do, and pretty much any lender to do at this point in time.
Yeah.
Yep. All right, so the last question, it's kind of related to Don Paulson's question, and we're going to wrap it up here. We had more questions come in. Some of you guys already answered a couple of your questions, and we're just running out of time, and I apologize because we could literally be here all night. But I want to honor everybody's time and thank you guys for spending 2 hours with us. But Dawn, her question is basically what I was going to ask you to kind of wrap up this call tonight with your predictions of the near future, meaning the next couple weeks, versus when we do come out of this, when that stay-at-home order gets lifted. What are your predictions for that near future of where things are going overall and with you and your company? Kenny, since the camera's on you, let's start with you.
I'm an optimist by nature, but at the same time, I have to be realistic about the situation.
Let's be real, man. Let's be real.
Yeah. And so I think the economy is definitely going to take this is just my personal opinion. This is not backed by, obviously the reading and things of that sort. But I think we're going to be in a little bit of a tough time over the next 24 months. To kind of get over this is going to be a little challenging. 10 million people applied for jobless unemployment over the last 2 weeks. That's hard hit. I live in the city. It looks like a ghost town. I don't see that. I mean, businesses would have to restart all over again, hire all over again, hire the folks that they did have again. It's going to take some time. It will take some time for us to get out of this. No one really knows what will happen over the next couple of weeks until this, as you stated earlier in the call, Dustin, the curve flattened. But I think from a lending perspective, once things do calm down, once we do realize that it's not as, things are going to be a little bit better, there's light at the end of the tunnel, as lenders, we will get a little bit more, we won't be as concerned, we won't be as apprehensive as we are now. And I think things will return to some type of normalcy. I do believe that the days of 65% leverage and 80% loan to cost and things of that sort are here for a long time. I don't see that changing anytime soon. One of the benefits of being, one of the biggest differences between now and 2007, 2008 is a lot of banks still do have liquidity. They're just trying to mitigate how they deploy that capital, how they deploy that liquidity. So that's another thing. We learned a lot from 2007 and 2008, but that's essentially what I think, we'll be okay. But it's going to be painful. It's going to be tough. We just have to come together and just try to figure it out together. And calls like this is what really will help a lot of folks just understand.
That's why we're here.
Yeah,
we do this.
What's going on in the market, because I hear so much misinformation and I hear so many, I don't want to say, I just hear a lot of nonsense all over the place, and I want to just tell people that's not how it works. And so it's just glad, I'm thankful. Thank you for having me on this call, because it's just good for us to just.
Well, I appreciate you being here, because we're all trying to put our heads together and wrap our heads around this and figure out how we're going to, like I said, survive and thrive in this new environment. So
yeah, we're going to get out of this.
We are, and we're going to do it together.
Absolutely.
Do it together.
Very
So this call tonight is just one of many that we're going to be having in upcoming weeks, talking about how to survive and thrive in this new environment.
Yeah.
Got nowhere to go.
What's that?
We've got nowhere to go, so.
Yeah. So we're gonna pull through this together. We are. So Stephanie, since the camera's on you, what are your predictions for the future overall and within your company, how you guys can help? How do you think you're going to come out of this, and when? You're gonna
The win is, I still don't know. Like I said, with DFW extending a shelter in place to May, I mean, I have to just know that's coming here next, and then after that, is it going to happen again? I mean, how long are we really in this? No one knows. Thankfully, I'm super blessed to work for a company, that has always, looked at the long-term plan, so I do think what Kenneth said, this 65%, LTV, 80% LTC days will probably come back on the other side of this, and ultimately may even be charging more as well on the other side of this, which could be good for us. So I don't know. It's really tough to say what I see happening. I will not say go back to normal. There won't be, what is on the other side of this will not be normal. We're going to have to adjust and adapt. It will not look the same. I do not believe that.
Well, if you get any insight from John, please share it with me.
I will.
And I'll share it out on Facebook with everybody. If you hear something, that goes for all of you. If there's any new change or anything, please share it with our audience. They'd love to hear it.
Of course.
I keep our finger on the pulse of what's going on out there. You're the guys and gals we turn to.
Yeah, and I don't mean to sound doom and gloom by what I'm saying. There's opportunity.
Here's what it is.
Yeah, but there is opportunity in all of this.
If there's a silver lining, please share.
I mean, I think it's just like the last, 2008, 2009. We look to the most recent recession, right? People came out of that, better, and we can all do the same. But like I said, we can't go, I just want to go back to normal. We've got to adapt to what's going on and what the new normal will be moving forward. That's going to be the key.
Karen, how about you?
Well, I'm always optimistic about the future. Yeah, this is just a little hiccup and a little bit of a hurdle, but I truly believe that Fannie, Freddie, Ginnie Mae, Penny Mac, I don't think they're going to let the housing market crash. I think there is going to be a market correction. So for those that do have investment property, my personal opinion, you do what you need to do for you and your family, but I'm like sell what you can sell, hold on to your cash, hold on to the ride, and those opportunities are going to be right around the corner. So all of these young people that has a lot of money, they're going to start injecting it into the stock market when we start to see the turn. So you're going to be able to get in the stock market, buy some stocks. You're going to get into the housing market, buy some houses that people are in distress with, pick it up, make a few bucks. So I think we're all going to come out this winning in the end. It's just how well are you going to play your cards throughout. So I'm busy. I'm working 10 hours a day, 6 days a week. I mean, people are buying, and there's true buyers out there. The tire kickers aren't out there anymore. It's true buyers, so people are buying. And like I said, the purchase rates are 3.25%, 3% if you get it on a good day.
Well, if you've got buyers, we got a couple beautiful rehabs out there. If you've got buyers who are not tire kickers, just so you know.
So, I mean, I'm totally optimistic about it. And, you know, we've been killing it at the bank, and we're the #1 mortgage lender, community bank in the state of Georgia, and construction lender. So, I mean, I love it. I mean, I'm looking forward to it. I'm sorry that what we're going through. My heart goes out to those that are going through this and have family members that are sick. So, please know that you're in my thoughts and your prayers every day, but I'm here to help and service and give information. And I just want to say one more thing about the banking piece.
Please.
If you qualify for PPP, Paycheck Protection Program, that program that's given out by the SBA, you need to contact your bank, an FDIC registered bank. Ameris Bank customers, you can go online to amerisbank.com and look up SBA relief, and it has all the information on there. So for those of you that can get free money, go get it and hurry up. We processed, as of yesterday, 3,500 applications. So there's a lot of money there, but we want to get in line and make sure that you're well taken care of. Take advantage of it. But thank you for having me. I think this is so much fun. I love it, and I love being on.
Me too. And I told you, I know you and I have been planning to do this for many months since we started. So I'm glad we finally got around to doing it. I hate that it was under this circumstance. We would have done this last month, but you were unavailable.
Yeah, I had another event to do.
Everybody else is available, so I postponed it a month so we can make sure you were.
I was working.
Now this happens. This happens.
Well, I'm always available for our community.
Yep. So one thing I just want to kind of remind everybody, we've been talking about this for months leading up to this, not leading up to this pandemic. We didn't know this was coming. But we knew a correction was coming. We saw the kind of the trend in Atlanta was starting to drop a little bit slowly. It was starting to trend downward. Some of the appreciation, some of the sale prices were starting to trend downward a little bit. Days on market was going up a little bit. And we kind of saw that as a sign of, hey, things are changing a little bit. We're going to start going through a correction here sooner or later. Then this happened. But so over the past, I don't know, 3, 4, 5, 6 months, we've been starting to talk more and more about seller financing. And you're going to hear us be talking about that a lot more in upcoming weeks. On Monday, next Wednesday, the second Monday of this month at our main meeting, you're going to hear us talking more and more about seller financing. Because some of the reasons we've talked about tonight, if we can't buy because we don't have the down payment or don't have the credit or whatever, because of the changes in the lending marketplace, we've got to figure out other ways to buy. And that usually happens when sellers can't sell all of a sudden. They're going through the same thing we are. They suddenly can't sell their house anymore. Maybe their value is dropping. Now that it's worth more than it's owed. Or maybe they're behind on payments and can't catch up. So we can start buying with subject to, lease purchase, lease option, wraparound mortgages, short sales. All that's going to start coming back in fashion again. And more people are going to become more and more motivated as time goes on. And we're going to have more opportunities to buy creatively than paying all cash all the time and using hard money, private money, and or bank loans to fund our deals. So the market's shifting. So where we've been selling, we may start buying creatively and starting to hold now. We'll see. These are just some of my predictions for the future, is that we're going to start buying deals more creatively because we kind of have to out of necessity as things change out there in the world. Less people qualify to buy. A lot of the tire kickers that Karen mentioned have gone bye-bye. Well, they still want a house, but they just can't go to Karen and get one right now. Well, that's where we come in. If we can go to these sellers and put the deal together with some sort of owner financing, we could turn around and pass that along to our buyer where they don't have to go to the bank and get a loan. We can take
Are
over.
you advertising that, Dustin? Owner financing in the MLS or on the listing?
You can. You certainly can. Yep.
Absolutely. Owner financing or a lease purchase. Oh my goodness.
Lease option, rent to
with
own.
non-refundable deposit, do 12, 24 months, whatever. They can come to the mortgage banker,
Yep.
me first,
Yep.
and they can get pre-approved and say, hey, look, you got some things to work on. And I'll suggest that to these real estate agents. I said, why don't you do a lease purchase?
Yep. And we can put them in with a mortgage broker or a lender who can pre-qualify and know that, hey, this guy's got some dings. It's going to take him 18 months before he can cash and get refinanced. They can put him on a credit repair program, whatever. But the point is, we're going to have to start getting more creative as we buy. More and more homeowners out there are going to start having problems where they haven't in the past because it's been a seller's market and they can sell it for full price. That's changing. That's one of the silver linings to this, if there is one, is that we're going to be a lot more people out there that we need to be able to help. So up until this point, we've been buying cash, getting all these loans, hard money, private money to fund our deals, sell. That's going to be changing a little bit. And you need to learn how to buy creatively if you don't already know. So when you hear us mention subject to lease purchase, sandwich leases, wraparound mortgages, start tuning in and start getting educated on that, especially during this stay-at-home order. You got plenty of time to learn some of this stuff. So when we come out of this, you'll be ready to go. And you can start advertising and marketing this while you're sitting at home because you get time to get on the computer and do all this. So that's kind of my predictions is we are going to come out of this. We're going to be just fine. We're going to do it all together. We're a team. That's what we're here for. Join your local REIA group, whether it's ours or somebody else's. Get involved. Hang around like-minded individuals who care and want to help see you succeed, and get educated while you can and start taking action.
Dustin, I totally agree with you. If you're not in a REIA, join one. Join this one.
Yep.
Because you are not going to learn if you're not in the circle and you're not asking the questions to professionals and to other people that have experienced it.
And we got some good people on the panel. We got some great people in our group, and they're all here, as you know, to help. And that's why we're here. And all of our REIAs, Savannah, Tampa, Chattanooga, Atlanta, all $100 a year to get involved. That's cheap.
So cheap.
It's been that way since 2010, since we started. We're going to keep it affordable because we don't want any obstacles for you to say, hey, I can't afford that. I can't get involved. I can't do it. Yes, you can. So that's what we're here for. So I want to thank each and every one of you. Stephanie, thank you. Nate, thank you. Kenny, thank you. Karen, thank you so much. Thank you all for being here tonight. Thank you, everybody who joined us and stuck with us for the full 2 hours. We hope you enjoyed it. If you want to say a few closing remarks in the chat window to our panelists, I'm sure they'd love to hear it. And because I couldn't broadcast this on Facebook, if you tuned in late or something, once this video is rendered, I'll probably throw a link up on the Facebook where you can watch this replay and share it with your friends if you'd like to. So say goodbye, everybody.
Goodbye for now.
Bye. Thank you.
And I put all these guys' contact information in the chat twice, so you have it. They gave it up verbally. So they're all on Facebook. I tagged them in the post for this event. They're not hard to find. Just Facebook them. They'd love to do business with you if they can help. Thank you guys all so much for being here tonight. Good night. God bless. See all of you real soon. Be safe. Thank you so much, guys. Gals.
Bye.
See you next month, Flip Chicks.